Good afternoon and good morning. Welcome to this special Reuters Breakingviews Newsmaker with Christine Lagarde, the President of the European Central Bank. I'm Rob Cox, the Global Editor of Breakingviews, Reuters' financial commentary arm, coming to you from Zurich, Switzerland. I'm shortly going to hand the mic over to my colleague Swaha Pattanaik, our Global Economics Editor in London, to lead the conversation. Before that, I want to do one quick housekeeping note. If you want to send us questions for us to consider posing at the end of the interview, you can do so using the chat box, which you should see on the right-hand side of your screen. Now, without further ado, allow me to welcome Madame Lagarde in Frankfurt. Hello, Madame Lagarde, how are you?
Hello, Rob. I'm very well, thank you. And you?
I'm great. Yeah, I couldn't be better. Thank you for joining us. Before I pass you over to Swaha, I thought I'd maybe just ask you a sort of basic, broad question, which touches on not only your current role at the ECB, but your extensive experience at the IMF before that in the French government. How concerned are you, and should we be, about what we see as the sluggish pace of vaccinations against COVID in the European continent relative to the US and the UK and some other places? And the potential for that to create an imbalance, if you will, in growth rates, prices, the price of money, that kind of thing. How should we, and how do you see this?
I think we should all be very concerned that vaccinations moves as fast as possible throughout the world. So I wouldn't focus on any particular region. I would focus on the rollout on a global basis of vaccinations. If there's one thing that we all took out of the IMF World Bank meetings that took place last week, is that the world is not going to be safe until everybody is safe. So having said that, things change fast. And what has been very fast is the finding of vaccination to begin with. And it's clearly the case now that there is a ramping up element, there is a rollout element about it, and things are going to continue changing almost as we speak. The Johnson & Johnson and AstraZeneca vaccinations, which, were regarded as one of the key 5 vaccines, are now being suspected in the US as well as in Europe, and things will continue to change. I think it's a process that we have to go through and that we are experimenting almost on a daily basis. But vaccination is a key, and it is a key the world over. It's not specific to a particular region.
But so you're not particularly concerned that the U.S. seems to be sort of roaring out in some mismatched way with Europe that creates some imbalance with trade or interest rates?
Look, it's not only related to vaccination. There are lots of components about it. The fiscal response, the change of administration have also had a key role to play in the way in which it is happening and it is perceived.
All right, we'll dive down further into that. Swaha, I pass the mic to you.
Thank you, Rob. Madame Lagarde, great to have you with us.
Great to see you too, and good afternoon.
Thank you. Rob's already got going with one of the biggest risks and uncertainties. Let me ask you about 2 other specific risks, one to the downside and one to the upside. First, how concerned are you that there might be parts of the economy which end up far more badly scarred after COVID than we'd initially anticipated? Secondly, on the flip side, do you expect to see much of a positive spillover from the massive US fiscal stimulus that you just alluded to?
Okay, following up from the upside that we can anticipate and the spillover that we can identify out of the US fiscal stimulus that has been voted. It's still early days, but clearly the ECB staff has already begun figuring out what the spillovers will be. And we're considering, and this is preliminary assessment, that there will be an impact on European GDP of about 0.3% at the end of our medium-term exercise, which is 2023, and that there will be an impact on inflation as well of about 0.15%. So there will be positive spillovers as a result of, as I said, what has already been voted by Congress in the US. There is clearly more that is in discussion at the moment that has not gone through Congress, which we don't really know yet what the amount will be. But what we know is that it will be over a much longer period of time. So I think that the assessment and the measurements of spillovers will have to be done in a very careful way, depending on which year those stimulus, I wouldn't call them stimulus, I would probably call them investment and transformational financing will affect the US economy. Now, turning to, and what I've just said is clearly an upside risk that we are seeing in the medium term. And we think, by the way, that the major impact will be in 2022. So of the 0.3% that I was referring to over the horizon, we think that about 0.2 will actually take place in 2022. Now, you are referring to the other element, which will have to do with a staggered recovery, if you will, where clearly some sectors, some countries will take a bit longer to recover, given the sectors and given the countries. One good example of that is transportation, which will be affected, which will be scarred, and which will transform itself probably in the years to come. Another one is the entire sector, which has been subject to the social distancing restrictions and will probably continue to be affected by those social distancing measures. They will take longer to recover. Those countries equally that have a large portion of their economy that is driven or geared towards tourism will also probably take a bit longer to recover. But, you know, I'm very cautious as I'm saying that, because we have been amazed, all of us, I think, at the way in which the corporate sector, the private sector, and households, families, people have actually responded to the crisis and have managed to adjust, to change the way in which we work. Look at you, you're working from home. I spend a lot of my time also working from home and operating with teams and using, you know, these web-enabled mechanisms. And it is not, I think, you know, reducing the efficiency that you display, that I try to display as well.
Absolutely. You talked about the corporate sector just now. Let me ask you about bankruptcies. It's been a very odd year. We've had a huge economic downturn, but government support has managed to prevent a lot of bankruptcies on both sides of the Atlantic. It's not just about Europe. How concerned are you that as government support inevitably starts to be withdrawn, we will see this wave of bankruptcies? And do you think banks are adequately prepared with their early warning systems finely tuned enough to deal with what we might see coming through the pandemic?
Well, there's no question that we will see more bankruptcies going forward than we have in the last year, and this is for very simple reasons that we all know. The guarantees that were put in place by governments, the moratorium that were decided, and sometimes the court system, which didn't work, were suspended, were under lockdown. All operated in such a way that the number of bankruptcy filings has been significantly lower in 2020 than it ever was before. So we are likely to see, inevitably, a catch-up, and some of those companies that would have filed for bankruptcy come what may in 2020, with or without pandemic rather, will probably resurface and will come to join the ranks of those that will file for bankruptcy. I think what will be critically important is the risk assessment that is organized in a most efficient and prompt way by governments in order to distinguish between those corporates that suffer from liquidity needs and those that have solvency issues. Because clearly the goal of everyone should be to avoid that a liquidity crisis of those corporates morphs into a solvency crisis. And I'm hearing that, you know, quite a few governments are already putting in place those mechanisms in order to expedite the risk assessment and to secure and protect those segments of the corporate sector that are only suffering from liquidity risks. You ask the question of the banks, and the banks are going to be critical players in that risk assessment mechanism. And I know that they are very concerned about it, and they want to be focused on that because they're talking about their client base, and they want obviously to support those client base as much as is possible, but of course as much as is reasonable. Hence, the real importance of this good risk assessment. We believe that banks are pretty solid. If you look at the core tier one capital ratios, it's at the highest level it has ever been. If you look at the overall capital ratio, very high as well. I think it's 15.6 for the first one, over 19 for the other one. And their liquidity coverage is also very strong. So they are currently in a very strong position, including to face some of those risks that would result from a larger amount of bankruptcies than what they've seen in 2020. And I believe that the supervision body within the ECB under the leadership of my colleague Enria has actually conducted stress tests in order to validate that. So that's reasonably comforting. But it requires that the impairment be measured properly, that things be done in a prompt and efficient way in order to distinguish, as I said, liquidity risk from solvency risks.
Let me turn to the non-bank financial sector. You recently said that it needs to be made more resilient through regulatory change. Could you talk us through why you think they need regulatory change, or what sort of things that you've seen during the past year that may make it necessary?
Well, I think that we all observed back in March 2020 that the money markets in particular was creating tensions, including through sectors of the financial world that was quite significantly regulated and was supervised. And that prompted all central banks of the world. I'm talking about the Fed, the Bank of England, Bank of Japan, and ourselves, to actually get involved and make sure that we could face the risk of liquidity crisis that could have occurred had we not acted at the time. So I think it is the joint intention of all parties, through the FSB in particular, the Financial Stability Board, to make sure that those risks do not arise again, and that enough regulation and supervision is exercised to those sectors of the financial markets that were left a little bit out of the regulatory and supervisory arm. That's to give you an example.
Thank you. Let me turn to the ECB as an institution itself. Crises like the pandemic shape not only our economies, but also institutions. The ECB is not the same institution it was when the euro was set up more than 2 decades ago. How do you think the pandemic has changed the ECB, its thinking, and what it's prepared to do?
I think any institution evolves over the course of time, and crises are generally great circumstances to actually prove your mettle and demonstrate that you can respond and that you can show the agility and the ability to adjust that is called for. And I think that on the occasion of the March 20 crisis, very obviously as a result of the pandemic, I think the ECB has demonstrated its capacity to respond very quickly, to respond massively, to break the mold, if you will, by demonstrating its unlimited commitment to the euro, and by being creative in the way in which we addressed both the financing needs of the economy with our targeted financing schemes, and by addressing the risk of fragmentation that we could see developing at the time back in March. So we came up with TLTRO on the one hand, and the Pandemic Emergency Purchase Program, which was the largest ever as we moved into the pandemic crisis. So from a pioneer institution as it was 20 years ago, it has certainly matured and gained in depth, in strength, and in responsiveness for a successful response to the crisis, I think.
One of the problems with the creativity has been it has also incurred quite a lot of criticism and, say, constitutional court challenges. I mean, do you think some of this creativity will stay limited to the pandemic era, or do you think it can live beyond that?
I think that the pandemic moment required emergency response. And the PEP, which is Pandemic Emergency Purchase Program, I mean, you can find all the keywords in there, was specifically dedicated and designed in response to that pandemic crisis. And it's an additional tool compared with other tools that exist and that will continue to be used. Instruments that include the very low rates that we have at the moment, the purchase programs that are in place and that pre-existed PEP, the financing schemes, and the forward guidance. So these four elements, if you will, are the sort of basic instruments that we have, given the situation that we're facing of this lower bound current environment. And PEP is an add-on that was specifically designed for the pandemic situation and the emergency requirements that called for, as I said, breaking the mold in order to respond and actually deliver on our mandate of price stability under those circumstances.
And let me ask you, I mean, what is very easy sometimes is to give support to the patient. Withdrawing support is really hard, even if the patient is convalescing. I mean, we saw in 2013, Ben Bernanke's taper tantrum. Now the world is much more indebted, companies and governments. So are you concerned at all that central banks, not just the European Central Bank, but any central bank, major central bank, risks a huge ruction in the bond market if it does start going down that road?
We have to look at the situation as it is and as it evolves. We are still clearly dealing with the pandemic crisis. Most countries in Europe are going through a third wave. We are still swamped with uncertainty. And not a day goes by without, yet another change, yet another vaccination hiccup, yet another increase in hospitalizations. So we consider that both fiscal and monetary support are needed and will be needed until the pandemic crisis is over. When I think of the economy, I think of a patient. I know this is not very good medical analogy at the moment, but think of a patient which is out of the deep crisis, but still on two clutches. You don't want to remove either clutches, the fiscal or the monetary, until the patient can actually walk fine. And to me, that means support well into the recovery so that economies can actually operate, walk, and function properly without support. For the moment, that support is needed, and that will be needed well into the recovery.
Absolutely. And as we said before, there is the risk of scarring and all those sort of forward thinking that you're looking ahead to. What would be sort of the necessary and sufficient conditions, if you like, looking ahead a few years for you to start thinking about this?
We have a reaction function that has been very clearly identified back in December. And the reaction function is to preserve favorable financing conditions. And this is clearly something that we're going to stick to and that we have clearly demonstrated in our latest decision in March. Preserving favorable financing conditions is for us a condition for the economy to recover and for our price stability mandate to be respected. They go hand in hand. And to do that, we're going through a twofold process, if you will. We want to make sure that conditions are favorable throughout the economy. And that means addressing the risk-free interest rates, the sovereign bond yields, the financing conditions available on the for the corporates and for the households, and determining whether, compared with previous such data, there has been an improvement, there has been stability, or there has been a worsening. That's step number one. Step number two, which is part of our joint assessment, we determine how those favorable financing conditions actually help us get back to the inflation path that we had pre-pandemic, pre-COVID-19, if you will. And it's on the basis of that joint assessment that we determine our monetary policy. We did that back in March, and very clearly it was considered by the Governing Council and by us at the Executive Board that it was needed to significantly increase our purchases, which we did.
And are you happy with the response? Because the financing conditions are almost day to day, the lifeblood of the market is telling you some of the financing conditions. Are you happy with where we are now?
We try to look at, we don't look on a daily basis, on a weekly basis. We have to be a little bit, we need to have a longer horizon than that. But it's the fact that what was decided back in March has had an impact and continues to have that impact.
Perfect. Let me start turning a little further out. It's in the central bank's DNA to look forward. So while we're in the middle of a health crisis, central banks everywhere look far enough forward to plan for, for midterm horizons. You started, when you came to the ECB, a policy review.
It was a strategy review.
Yeah, absolutely. And as part of that, your senior officials yourself, you've been talking to a wide range of people in a sort of ECB Listens outreach program, if you like. What are your main takeaways from what the central bank has been hearing, and how does this feed into the ECB strategy review?
You're very correct that we conducted that exercise of reaching out, listening, and bottling in order to make sure that that actually is part of our strategy review. And that was conducted at the ECB level and at all national central bank levels as well. So in each of the 19 member states of the euro area, such exercises were conducted. Let me tell you what key concerns we heard. I think concern number one, expressed by those who joined, was the issue of measurement of inflation. How prices increase, why, how do you measure it properly? Do you account for, say, for example, food and energy? Why is it not included in core inflation? And more to the point, for people's concern, is housing cost, which is so important, particularly for young people. Is that really factored in properly in the inflation measurements? Number one. I think concern number two, which we took away as well, was the concern that people had about some externalities that impact prices, that impact people's life, and that impact the risk horizon and assessment that people conduct. And I mean by that climate change. If we did not hear it on the occasion of the ECB Listens, we will never hear it. The third component had to do with income and pension. So as you can imagine, all these things, inflation measurements, climate change, impact of monetary policy on income, all of those points will find their way into our strategy review when it comes to inflation measurements, when it comes to the impact of climate change, when it comes to externalities and the assessment of monetary policy.
The Federal Reserve is a little way ahead of you. It started before you with its Fed review and is a little bit way ahead. Central banks in the developed world are all independent. But to paraphrase John Donne, no central bank is an island. So I was wondering whether you think that what the Fed has done, which is to say that it will tolerate some overshoots in inflation, and that it is really gunning for more inclusive growth. Does that shape how other central banks think, and will it shape central banking in general? Somebody has to go first, and that's the vanguard, perhaps. I don't know whether you think this is appropriate or any of this may have a gravitational pull for the Eurozone in the future.
Well, first of all, I would observe that I started the strategy review as I started my job. So there was no way I could have started earlier, which is why Chair Powell was a little bit ahead of us. And I'm leading that exercise as fast as I can, because I think it's important that as we will be transitioning, hopefully post-pandemic one day, we have a strategy review that is firm and well understood. It's difficult to compare the Fed and the ECB from that perspective of inclusiveness, because the employment objective that the Fed has explicitly in its mandate, together with price stability, is the instrument through which inclusiveness can be taken into account for purposes of monetary policy. And to measure that, clearly Chair Powell and his FOMC have granular, detailed information about employment rate, participation, unemployment, and they can really drill down into minorities' employment or unemployment, improvement, progress in that respect. The ECB does not have employment as one of its objective, because our mandate is price stability, full stop. Now, we do have secondary objectives, and you can include in the secondary objectives multiple factors, in particular, the economic goals that are pursued by the European institutions at large. But we don't have as much of an impetus on employment, which is the right channel to assess inclusiveness.
And do you think, you mentioned climate change earlier, and this is part and parcel of your review, and while it is not a mandate, your colleagues at the ECB have shown very clearly how it can impact monetary policy thinking, how it impacts financial stability risks. What do you think is the best way for a central bank to encourage sort of a carrot and sticks approach, if you like, and align sort of the prices in markets that people dictate to the values that you are talking about that society has to stop climate change sort of posing such a threat?
Okay. The key players, the driver of that bus, if you will, are not the central bank governors. They are the finance ministers, they are the governments, they are the policymakers. But what we central bankers can do is to align and join forces with finance ministers, with governments, in order to contribute our share in what is and should be a common cause for all, where each and every one of us, wherever we are, ask ourselves, what can I contribute? What is within the parameters of my mandate that will actually have an impact on what is that common cause of fighting climate change? And I think that from a central bank perspective, you can do it in two different ways. One is by asking yourselves, from each and every segment of your action, how can climate change lead me to vary my models, to better understand where natural interest rate is, to better appreciate how much monetary policy room I have, to better factor in the risk that climate change has on the inflation measurements and inflation in general, and how fiscal and monetary intersect through, for instance, the intervention of carbon tax. That's number one. And it has many, many ramifications. It means changing the models that we use to make sure that it's in there. It means making sure that we anticipate such things as carbon taxation. It means that we understand better the behavior of consumers to see whether or not they change their saving patterns depending on how they assess climate risks going forward. The second aspect of what we can do is actually from a risk management point of view, look at our portfolios, whether non-monetary portfolios, which we are already doing quite a lot, or monetary portfolios, which means, should I continue valuing collaterals in the way I do, or should I make sure that I'm attentive to the taxonomy that is now being put in place and improved in the course of 21? And I think the same goes for purchases, for those central banks that are purchasing corporate bonds, as the ECB does. Should we pay more attention to taxonomy going forwards? And the third element, which I touch on only very briefly, because we have this separation and this sort of Chinese wall between supervision and banking and central banking, monetary policy determination, is through supervision, is by expecting that banks will themselves measure the climate change impact on their portfolio, on the value of their corporate clients, and the value of the collaterals that they pick up along the way. In addition to that, that supervision arm should, of course, use the tools that it has, which includes stress testing, which includes guiding principles, and that is being done as we speak by the ECB, because I think that we tried to move as fast as we could.
And are you using those sort of modeling things that you talked about in the first strand already, or how far are you along the line to finessing those models and making it an integral part of decision making?
Well, as you rightly said, climate change is one of the components of our strategy review. And we have that agreement amongst members of the Governing Council that nothing is agreed until everything is agreed. And I lead the process of the strategy review with that very much in mind. So I'm fairly convinced that we will, at the end of the process, settle on revisions of our models. We have begun that exercise, by the way, because it's not an instantaneous process. It's one that actually takes quite a bit of time. But we have begun that process, and I'm sure it will be rolled out in a much more decisive and determined way once the strategy review is over.
And I don't know, while the review isn't perhaps over, I don't know whether I could ask you for your personal thoughts on where you stand on the sort of pure green, light green, sort of semi-olive color, whether, you know, when one looks at green bonds or anything, should one also include transition sort of funding and say, well, that's also worth funding, maybe clearly labeled, but should the green taxonomy be widened enough to include things like natural gas? I mean, that's a huge debate at the moment. I don't know where you personally think. I know it's not necessarily agreed at review stage.
You know, my take on that is that there should be as much integrity and as much as science-based understanding of the multiple shades of green. And it's a matter for the Commission and the European Parliament to decide upon. They've moved ahead rapidly since July. The taxonomy is in place. It certainly settles what is green. There is more underway at the moment as we speak, and I think the 21st of April will see developments, and it will be an ongoing process, because clearly, while there are some clear-cut identification of what is green, there is also some not so clear-cut identification of those that are more in the brown but are trying to move into the green, and which have to be supported from a financial point of view into that transition. So I think the zero net budget, zero net emission budget is also going to be an area where more work will be done. And I have to say that I'm very impressed at the moment by the sort of commonality of views across the board and across the pond, including the United States, in order to move in the right direction.
Let me ask you about another big project, not necessarily that you own this time, and you have enough on your plate, which is the reform of the Stability and Growth Pact. Not your problem, indirectly perhaps, but you both, when you were French finance minister in the past, you have been the head of the IMF and given advice to governments about what sort of what is the best model for fiscal policy for particular countries? What sort of things do you think we should be looking at for all institutions that care about the euro's well-being and soundness? What should the Stability Pact reform think about? The big picture one, not the short-term one, about extending sort of suspensions.
Well, you kind of responded for me by saying this is not really my business anymore. I will only say this. First of all, I think it's a good thing that the Commission and the Council and the finance ministers have this agreement that the escape clause will apply until the end of 22, because that really coincides with what we perceive as a possible horizon for the pandemic to be behind us. We don't know for sure, but we certainly look at 22 as being the year when the European countries will get back to pre-COVID-19 growth. I think the second point I would make is that Europe works on the basis of rules. It is a rules-based construction, and an extraordinary one that is often criticized, that sometimes stumbles along the way, but which eventually, and for the last 70 years, has stood the course of crisis and criticism for that matter. And rules are important. So there will have to be some rules. Whether they will be the same as the ones we had that we inherited from way back, probably not, because times have changed and the level of debt, the necessary measures that had to be taken have had the impact on European societies and European economies. So I would hope that the best brains will assemble to define what will be the new Stability and Growth Pact, and will have basic principles of simplicity, of operationality, and will support actually, counter-cyclical operations more so than was the case in the past.
And one of the things that the ECB, time immemorial, as far as I can remember anyway, has called for is better structural reforms. I mean, that goes hand in hand with having more latitude on budgets and stuff like that. It's a hard time to ask anybody to do structural reforms now, but how focused do you think minds are when you talk to finance ministers and people in governments around the Eurozone?
I talk to quite a few very determined finance ministers who fully appreciate that what has taken place in Europe with Next Generation EU, this unbelievable breakthrough in the European Union, countries deciding to jointly borrow and to give grants to the most affected ones, which had never happened in the past, is a moment that needs to be a success. And for that moment to be a success, it has to be transformative. So I see many countries that are determined to face those changes, to go through the structural reforms that are by necessity painful because you change the order of things because of that breakthrough, because of that moment in European history where solidarity is not just in words, but is displayed in euros, and where they cannot miss that opportunity.
Perfect. I have a lot more questions, but I want to give the audience a chance to ask theirs. So I'm going to throw it back to Rob, who's been collecting questions. I'll come back at the end with a couple more for you, but Rob, let me hand over to you and the audience questions.
Sure. Thank you. This is great conversation. It's obviously sparked a lot of questions. They're sort of in different groups. Let me start with one. There's a lot of questions about the fiscal response to the pandemic by the United States, and some questions about whether it's too much. So some people have pointed out that Larry Summers had called the fiscal response substantially excessive. He's been on the record about that. What's your take, Madame Lagarde, on the U.S. fiscal response? Is there a concern that it's too much, that it will spark inflation, or that Europe will be left behind because European nations aren't putting so much money into the economy?
I think the jury is out. And when I look at those who take the floor on this issue and who know the US economy better than anybody else, you have a large majority who support the fact that there will not be significant inflation or reflation arising out of this fiscal stimulus. I think it's all a factor of really where is the output gap at the moment, how much slack is there in the economy, what will be the bottlenecks, and how much price pressure there will be as a result. I'm interested in what impact it will have on the euro area, and in that respect, we see positive spillovers coming out of the U.S. Fiscal stimulus that has been voted already. As I just said earlier on, we see 0.3% additional GDP. We see 0.15% additional inflation on the medium-term horizon. That is positive as far as we're concerned. And we also have a monetary policy instrument and responses in order to actually resist those yield increase that we would see as unwarranted or premature as far as the euro area is concerned.
Let me turn to climate also. You and Swaha have spoken quite a bit about this, but there are quite a few questions. One kind of concrete one here is, how important is this year's climate change COP26 in terms of addressing the overall climate emergency, and what role will central banks play?
I think the Glasgow COP26 is a critically important moment, if only because there is much increased or added momentum around the world than there was even during the Paris COP, if you will, when the Paris Agreement was struck. The fact that the US has completely turned around and decided that climate change was critically important going forward, and is now really sort of moving forward both at the Treasury level and at the Fed's level, are going to have an impact on how COP26 evolves. But I wouldn't be surprised if there were some significant breakthrough and move towards accelerated response to the climate change threat that we face. And I think it will also enlarge beyond pure climate change. It will probably include broader environmental goals, such as the protection of biodiversity, for instance, which had not been at the forefront back in the previous COPs.
Well, you answered another question. Biodiversity just had come up as well. Let me ask you, just to turn, today Coinbase went public in the United States. It looks like it has a market cap of something in the order of $150 billion. So lots of talk about digital currency here, lots of questions. One of the questions that came up is, what kind of regulation should we expect in coming years with regards to cryptocurrencies by central banks?
I'm not sure that regulation will come from the central banks. I think regulations will come from the authorities in charge of regulation and then supervision. If you look at Europe, for instance, MiCA, which is the regulation concerning those instruments, is now in review and will include appropriate regulatory framework for the crypto assets. I wouldn't call them cryptocurrencies, by the way, because I don't think that they are cryptocurrencies. They're crypto assets. They should be well parked in the regulatory environment within which we function, and there should be enough supervision so that consumers appreciate what risk they go into and what speculation they are the object of.
The other sort of corollary question is that the ECB is doing a lot of work on a digital euro. While things are still at a very early stage, the huge response to your consultation showed how much interest there was in the subject. Why go there at all? And sort of in a broad outline, maybe, what would it look like?
Why go there? Clearly because there is a demand. we are seeing throughout Europe and to various degrees depending on countries, a shift by consumers to digital tools when it comes to ordering, to purchasing, to paying. And when you look at countries like, for instance, Sweden, it's fairly obvious. Now, Sweden is outside the euro area, even though we do interact on our payment infrastructure. But if you look at a country like the Netherlands, there's been a clear shift towards digital payment and less use of cash. The same is even true in Germany. You know, Germany was famous within the euro area for its extensive use of cash. About 80% of the transactions were conducted in cash. That has also reduced quite a bit. Is it to say that it will substitute cash? No, but there is clearly a demand on the part of consumers for digital payments and digital currency. Second, there are around attempts by private issuers of something to actually come up with a digital thing, which would be convertible in various fiat currencies, fiat money, if you will. Clearly, the dollar is the one that is being targeted at the moment. We think, we central banks, and I'm not the only one here, there are, you know, at least 80 central banks around the world that are looking at digital currencies. We think that it's a duty of us to actually have available digital currencies that would operate to the benefit of consumers. So what would it look like? Well, it could be used like banknotes. I don't think it is like banknotes because it will not have the degree of anonymity that banknotes have. And I find it very interesting, by the way, that in the consultation that we conducted, that consumers who responded in very large numbers said, we want our privacy to be protected, but we don't want anonymity, because they understand the risk of anonymity when it comes to digital currencies. And they appreciate that the financing of money laundering, the financing of terrorism cannot use digital currency as a cover. So there is huge wisdom in the response that we got from the Europeans.
Thank you for that. Just sort of bigger picture question, sort of related to COVID. How can the leading economies of the world, and central bankers by implication, work better together to prepare for large-scale shocks, pandemics, disasters, I don't know, earthquakes, whatever it might be, that seem to be occurring with greater frequency?
Well, when I look at what has happened, I have to say that central bankers actually coordinated, cooperated, compared notes, responded very quickly, very efficiently. When I look at the reactivation of the swap lines, when I look at the repo lines that we put in place, the response was very rapid and very significant. We had learned back during the great financial crisis that cooperation was a necessary response. I think we did it yet again. And there was no question of time of the day, time of the night, size of the bank, personality of the governor. We all ganged together to make sure that we responded with enough liquidity and with enough reassurance so that we could deliver on our mandates, but we could also keep the economy afloat despite this pandemic threat.
So that's an interesting point. I know Mark Carney has written about this and made that point as well. And it's, of course, you were involved in the response to the financial crisis. Is there, but central bankers have done that. World leaders we seem to have all gone in different directions in many cases. I mean, the vaccines point is an obvious one. Are you worried about the leadership of the world effectively being prepared to deal with something as dramatic as climate change?
I think Glasgow COP26 will give us the answer. And it will have to be a show of being in it together, fighting against it together, and making sure that those that are most exposed, most at risk, also have the support of the others. There has been much progress on that front between the early days of the UNCCC and the various COPs, but still much needs to be done. We'll see it in the vaccination process as well. You know, it's striking that advanced economies are much more advanced in the vaccination than the emerging market economies, and even more so the fragile or developing countries. As I said, vaccination will, will actually determine whether we are out of it or not.
Right. No, that's absolutely true. Are you concerned that the way that the pandemic has panned out will create more inequality in the developed world and between the developed world and the emerging world?
Yes, is the answer. Yes, is the answer. When you look at those most affected, if you just look at jobs, those most affected by the pandemic in advanced economies were predominantly the lower paid people, women, and young people. So those that were already at a disadvantage in many ways are going to suffer setbacks. If you listen to the World Bank or the IMF, they will also indicate, you know, how many more people are in extreme poverty as a result of the pandemic. So yes, inequalities will have worsened within countries and between countries as well, which is why something like Next Generation EU is critically important in this part of the world, in Europe, so that those countries at a disadvantage actually receive more than those that will cope better with the pandemic.
Madame Lagarde, can I just jump in and ask you as a follow-up to that? I think Rob has a couple more questions perhaps. But I mean, what you say about inequality within countries, it's hard for a central bank like the ECB, which looks holistically, or traditionally has, at the Eurozone as a whole, and then to look at this focus as no one left behind, if you like, in countries or within countries. I mean, is that something that the central bank can do?
Well, we contribute to it. As I said, we have a mandate, which is this price stability. And I think that a central bank like the ECB contributes to reducing inequalities to the extent that it can within that mandate. It has been calculated over the course of that period between 2014 and 2019 that the ECB contributed to the creation of this additional 11 million jobs. It didn't create the 11 million jobs, let's face it, but it certainly contributed to the creation of these jobs by maintaining price stability, by making sure that the economy functions, that making sure that the corporates from SMEs to large accounts can actually have access to financing. And I think the same is true in the period between March 20 and now. We have contributed to reducing the impact that the pandemic would have had it not been for us being extremely active and very fast on the pedal.
Thank you. Back to you, Rob.
Okay, well, I'm going to go through these questions. Here's one I got to ask it because it's so direct. Is there a possible rate hike plan for 2022, and what would lead you to that?
I think that's a very much too short a horizon, as far as I'm concerned.
Got it. That's a good answer.
And by the way, for those who are really interested in those questions, and I can see who is asking those, we give very, very clear forward guidance, both in relation to our asset purchase programs and in relation to interest rates hikes. So, we cannot be clearer than that. And we are clearly referring to inflation converging, significantly, sustainably towards our aim. We are very far away from that.
Yeah. Would the shift to digital payments have occurred if it hadn't been for the COVID pandemic?
Sorry, I missed the beginning of your question.
Sorry. I mean, would the shift to the dramatic shift, let's say, to digital payments have occurred if it hadn't been for the pandemic or the scale of the pandemic?
Probably not at the speed as we are seeing it. There were only a few central banks that were looking at it, China being a point in case, because it started back in 2015. But the pandemic has accelerated just about everything. Every phenomenon that you can think of has been accelerated by the pandemic. Payment is one.
Yeah. A question from George Buckley at Nomura. How are decisions made about how many bonds the ECB buys each week? The BOE is very precise, but this is not the case for the ECB. Why does it change from week to week? And on what basis is the decision made?
Well, as I indicated, we back in December, we decided that we would preserve favorable financing conditions. And by moving from this sort of volume-based to the dynamics of financing conditions, we conduct a joint assessment. We look at the whole range of financing, from risk-free to volume and rates of lending to corporates and households on the one hand, and then we look at inflation outlook, and we jointly assess the two, and then we decide what kind of purchases is necessary. In March, we decided that a significant increase was needed. And if you compare the average purchases on a weekly basis before that and the average purchases since that, we've increased by more than 50%. So we determined that that significant increase is in line with what we want to do, which is to preserve favorable financing conditions.
Swaha, do you want to ask one last question before we wrap up?
Absolutely. Let me ask you, we're always fighting the last war, Madame Lagarde, and quite normally our heads are very preoccupied about the pandemic, preventing another health crisis, these sort of things at the moment, and making our economies anti-fragile, resilient, whatever you want to call it, for this sort of crisis. What do you think we should be worrying about next? And what is the next war, if you like, that we should be thinking about protecting ourselves against?
You know, on that front, I share the view of Jay Powell. I'm very concerned that with more and more sophisticated payment infrastructures, more and more actors involved on the financial scene, that we are exposed to potential cyber risks and cyber attacks against which we have to defend. This is in addition to all the other risks that we have to face and that are on our radar screen. But this one, which has not really materialized, because we've seen a couple of serious incidences most recently, but this one is something that preoccupies me on the financial scene that we operate.
Thank you very much. Let me hand back to Rob.
Okay, well, thank you, Swaha, and most of all, thank you, Madame Lagarde, for your time today. Really appreciate that.
Great pleasure to be with both of you.
And folks, if anyone wants to replay this conversation, you can do so on your Icon terminals and shortly on breakingviews.com, where we'll publish an audio version. And thank you, stay healthy. We're almost over this pandemic, I hope. And be good, everybody. Thank you.